3 secrets trading bot sellers won't tell you. The alluring promise of automated wealth. You've likely seen them. The online advertisements for trading bots showcasing perfect, ever-rising profit curves. They promise a continuous stream of automated profits month after month, presenting what looks like the ultimate key to financial freedom. With results like that, who would ever need to work again? This raises a critical question. If these systems are so perfect, why isn't everyone already rich? The answer lies not in a revolutionary algorithm, but in a carefully constructed set of illusions designed to exploit a trader's hope and hide a catastrophic flaw. The truth is that a dirty secret lurks behind these polished graphs. This article will reveal the top truths that trading bot sellers don't want you to know. Secret number 1. The perfect profit curve is an illusion. The primary trick sellers use is showing the balance curve while deliberately hiding the equity curve. To understand this manipulation, it's essential to know the difference between these two terms. Balance. This is the account value considering only closed trades. Since Grid Martingale bots are designed to only close groups of trades when they are in profit, this curve logically always goes up, creating the illusion of a flawless system. Equity. This is the real-time, total account value, which includes all open, and often massively losing, positions. In short, equity is your real-time, walk-away value. It's the truth of your account's health, moment by moment. The contrast is stark. While the balance curve climbs smoothly, the equity curve tells the real story. It frequently experiences massive, sharp plummets, dips, that represent the true, terrifying risk of the entire account being liquidated in an instant. This visual trick is powerful because it preys on the desire for simple, clean results, making the hidden risk feel abstract and distant. When people try to sell you this type of expert advisor, they usually show you the balance. What they don't show you, however, is the equity. This illusion of a perfect balance curve is the primary tool used to execute the next part of the deception, hiding the dozens of accounts that have already failed. Secret number 2. They only show you the survivors. To create the illusion of a reliable strategy, sellers rely on a statistical manipulation known as survivorship bias. Their process isn't about finding one perfect strategy, it's about playing a numbers game and showing you only the lucky winners. Here is how the process works. They don't run one large account. They launch dozens, 20, 50, of small accounts with various settings. They let these accounts run secretly for 6 to 12 months to build a history that appears credible. When an account inevitably crashes, blows up, they simply delete it or hide it from public view. They present only the surviving accounts, those that got lucky with favorable market conditions, to potential customers, creating the false impression of a 100% successful strategy. This is a continuous cycle. While the current survivors are being marketed, a new batch of accounts is already being tested in the background to replace them once they eventually fail. Survivorship bias works because we are psychologically wired to focus on success stories and rarely think to ask about the failures we can't see. And the reason these accounts inevitably fail is rooted in the fatal mathematics of the never lose strategy itself. Secret number 3. The never lose strategy is designed to lose everything. Now we arrive at the core mechanical flaw that makes this entire system so dangerous: the Grid Martingale strategy. Think of the Grid Martingale strategy not as an investment, but as a ticking time bomb. It generates small, consistent profits that feel safe, but the entire mechanism is built around a single, inevitable detonation point. Here is how the strategy works in practice. When a trade goes into a loss, instead of closing it, the system opens a new trade in the same direction but with a larger size, e.g., doubling the position from 0.01 lots to 0.02, then 0.04, and so on. This creates a grid of trades with rapidly increasing floating losses. The magic and the danger. is that a very small price movement in the right direction is all that's needed to close the entire group of trades for a small, combined profit. The fatal risk is clear. If the market makes a long, sustained move in one direction without a sufficient pullback, the floating loss grows so large that it triggers a margin call, leading to the liquidation of the entire trading account. A disciplined approach. Can this strategy be tamed? While the standard model sold online is deeply flawed, the underlying strategy can be managed with extreme discipline. Acknowledging the risks allows for a more controlled approach. A safer approach is built on two key pillars. 1. Diversify across multiple small accounts. Instead of risking all your capital on one large account, split it among several smaller accounts running different strategies or currency pairs. This contains the blast radius. If one account fails due to a volatile market move on a specific currency pair, the others remain unaffected. 2. Implement a hard stop loss. This is the most critical change. Instead of letting the bot run until it inevitably crashes, you set a predetermined maximum loss for the entire strategy, e.g., $1,000. This single change is non-negotiable because it fundamentally alters the strategy's DNA, transforming it from a game of unlimited, catastrophic risk to one with a defined, acceptable cost of doing business. Conclusion. Look beyond the perfect curve. Grid Martingale strategies are marketed with a promise of risk-free profit, but their core design is engineered to eventually lead to a total loss. The entire marketing model is a chain of deception. The seemingly perfect balance curve, secret number 1, provides the proof needed to market the lucky survivors. Secret number 2, of a strategy that is mathematically designed to self-destruct, secret #3. Before you trust any algorithm with your hard-earned capital, ask yourself, are you being shown the full, unedited story of risk and reward, or just the chapter they want you to read?